Most people think a reverse mortgage means the bank ends up owning your house. And that's not how the loan works. And it's not how any HECM has ever worked. I've spent 23 years as a mortgage broker, most of that specializing in reverse mortgages, and I want to walk you through exactly how this loan is structured, what protects you, and what you're actually responsible for. In this video, I'm going to show you how a reverse mortgage works, who qualifies, how the money reaches you, and what happens to the home when the last borrower is gone, using the actual federal rules that govern this loan. So here's the confusion first. On a normal mortgage, the one you probably had on this house at some point, you start with a big balance and pay it down every month. Your equity grows because your balance shrinks. A reverse mortgage flips that. You start with a smaller balance. You're not required to make monthly payments, and the balance grows over time instead of shrinking. The lender pays you or gives you access to funds instead of you paying the lender. There are a few reverse products out there, but the one that matters for almost everyone watching this is the home equity conversion mortgage. It's insured by FHA, which is part of HUD. That federal insurance is the reason it has better terms than any private reverse product, and it's the reason the non-recourse protection I'll get to in a minute even exists. People assume qualifying for a reverse mortgage works like qualifying for any other loan. Credit score, income, debt-to-income ratio. It doesn't work that way, and that's actually one of the more useful features of this loan for a lot of retirees. To be eligible, you need to be 62 or older. The home has to be your primary residence. It has to meet FHA property standards. You also complete a HUD-approved counseling session before you can move forward. That's a federal requirement, not a broker requirement. And it's there to make sure you understand the loan before you sign anything. You do need enough equity in the home after paying off any existing liens, not just a first mortgage, any lien against the property to support the loan. How much equity you need depends on your age, the home's value, current rates, and which payment option you choose. Now, here's the part people get wrong. Instead of a standard debt-to-income test, HUD uses a residual income standard. That means they look at your income, subtract your expenses, and confirm what's left over is enough to cover your property taxes, your homeowner's insurance, and your HOA dues if you have them. Those three expenses are required on any mortgage, reverse or forward, or even if you own your home outright. That's not a reverse mortgage requirement. That's just owning property. The residual income standard exists because a lot of retirees have a paid off home, strong credit, real assets, but their monthly income dropped enough that they wouldn't pass the normal 50% debt to income test. The reverse mortgage's qualifying standard was built around that exact situation. If this is the first video of mine you've watched, subscribe. I'm covering the parts of this loan that actually matter, not the version built to scare you or the version built to sell you. Once you qualify, you're not locked into any way of receiving funds. You can take a lump sum at closing. You can set up a systematic monthly payment. You could open up a line of credit that grows over time. And this is not the same as a HELOC. The growth mechanics work differently, and I'll cover that in its own video because it deserves one. Or you can combine any of these. Most of my clients take a partial lump sum up front, then leave the rest sitting in that growing line of credit for whatever comes up later. Which option makes sense to you depends on the HECM type you choose, your home's appraised value, the age of the youngest borrower, the rates, and any existing liens being paid off at closing. I've been doing this for 23 years, and I see the same three situations come up again and again. First is the immediate need, medical bills, home repairs that can't wait, or helping a family member. Second is lifestyle, freeing up monthly cash flow because you're not making a mortgage payment anymore, which opens up things like travel or home upgrades you'd otherwise put off. Third, and this is the one financial advisors bring me into, using home equity as a deliberate piece of the retirement plan instead of pulling from investment accounts early or triggering tax consequences on a deferred account. Home equity is one of the largest, least used assets most retirees have. That's exactly why more advisors are starting to factor it into the plan instead of ignoring it. That said, this isn't the right move for everyone. If you're not planning to stay in the home long term, a reverse mortgage usually isn't a fit. This loan works best when it's your forever home. And if the number only frees up a small amount, just enough to cover an existing payment without solving the actual cash flow problem, that's worth a real conversation before moving forward, not a quick yes. This is the question I get more than any other, and it's the one the fear-based content leans on hardest. Does the bank take the house when I die? No. A HECM is a non-recourse loan. That means neither you nor your heirs will ever owe more than the home is worth when it's sold, no matter how large the balance has grown. That protection is backed by FHA mortgage insurance, funded through premiums collected on every HECM, which is what allows HUD to guarantee that outcome across the entire program. When the last borrower passes or permanently leaves the home, your heirs have real options. If there's equity left in the home, they can sell it and keep the proceeds. If one of them wants to keep the home, they can pay off the balance or refinance it into their own name. If there's little or no equity left, they can pay off the lesser of the loan balance or 95% of the home's appraised value to keep it. That's the non-recourse feature working in their favor. And if nobody wants a home, they can walk away with a deed in lieu of foreclosure and owe nothing further with no impact on their credit. One more thing worth knowing here, if you have a spouse who isn't on the loan as a borrower, HUD has a special protection in place that can allow them to remain in the home as long as certain conditions are met after you're gone. That's a conversation worth having directly with a broker before you close, not after. And while we're clearing up misconceptions, you're not required to make a payment on this loan, but you're always allowed to. A lot of my clients make voluntary payments specifically to slow down balance growth or preserve more equity for their heirs. That's your choice, but it's not a requirement. So here's what actually matters. You don't lose the house. The FHA insurance behind this loan guarantees that. You get paid through a lump sum, line of credit, monthly payments, or some mix of those three. And what's asked of you in return is the same thing asked of any homeowner. Keep the taxes, insurance, and HOA dues current and live in the home as your primary residence. If you're 62 or older and you want to know what this actually looks like with your home, your numbers, your situation, book a call with me and I'll walk you through the same way I'd walk through it with my own family.